Start recording. That is important. Welcome to the PitView Education Series. I am your host and instructor, Steve Nuri. Most of you probably know me by now, but if not, just a little bit of background on myself, since this is only about the third or fourth educational webinar that I've done for PitView. Let me just state a little bit of my background. I started off as an options trader on the floor of the CBOE. I moved on to futures. I was also an instructor for the CBOE and for the Mercantile Exchange. Quickly moved into Forex trading, where I was recruited to not only, I became enthralled and in love with Forex because I felt like it was such a huge market and it put people on kind of the same wavelength as the institutional traders in the market, and PitView is one of those tools that puts people on that same level playing field, I believe, as the institutional traders in the market. And so I got recruited to be an instructor. I've traveled around the world teaching Forex trading. And the purpose of our education series in PitView is because I know a majority of you are subscribers to PitView. And since it is such a new tool out there for the retail public, a lot of people get that education is important when it comes to any type of tool or any type of method when it comes to trading. So the purpose of these webinars is not only to get people up to speed on the basics, but in this case, this is more of an intermediate style webinar where we teach you a little bit more of how to implement PitView into your trading method. Let me throw up our little risk disclaimers here. Risk disclaimer, this is risky. Any type of high risk, high reward investments such as Forex, futures, options, they all carry a fair amount of risk. That's what we get in it for. We know it's risky. The reward potential is there, but there's also the chance of losing money. And not just the chance, it's pretty much guaranteed that you're going to lose money as far as on some of your trades. That shouldn't scare you, by the way. I'm just saying that this is not a 100% success rate game. Most of the time we're trying to get better than a coin flip in trading. So past performance not indicative of future results. Anytime I talk about trades, trading methods, just because something worked in the past doesn't mean it's going to work in the future. I always find that the fascinating thing about the markets is that the market characteristics and markets are constantly changing, and make sure when you are trading that you are using risk capital. Today we will cover using PitView for trade confirmation. Now, this is based on some feedback that I've gotten back from several of you and several students of mine as far as how to use PitView. What are some of the most simple ways in which we can implement PitView into a trading method? Now, you'll have to be extremely patient with me during this. I know a lot of you are PitView subscribers. Some of you are institutional traders, professional traders. Some of you, and a lot of you I know, are retail traders that subscribe to PitView. You be patient with me as we go through this presentation, because what I commonly get from students is a lot of people might think or come under the assumption that PitView is some kind of black box. If you don't know what a black box is, it's an indicator that that tells you when to buy and tells you when to sell. I wouldn't even teach it if I thought it was just a standalone like black box trading method, because that's not what it's meant for. It's meant to be a tool. It's meant to be a tool in your trading that you can use for entries and exits if you wish, and we will cover more into that. But I thought the best way to cover it from here, based on feedback from last Wednesday's webinar that we did, is to start by going over a very simple, basic trading method and show how PitView can improve the results on just a really basic, high probability trading method that's really easy to understand. It's a short-term trading method, and it's one of my favorites to trade. So I'll be giving you one of my methods that I use to trade the market as far as over the short term. Last Wednesday we covered a little bit more on, we covered a bit on swing trading, of looking at market on like the 1 hour, 4 hour charts. But based on some of the feedback I've gotten, I know a lot of you are more short-term traders. So that's what we're going to look at. We're going to look at one of my short-term trading methods. It's not hard, it's not difficult to understand, and show you how PitView can be implemented into that method as a trade filter and trade confirmation tool. So if that sounds good to everybody, we'll go ahead and get rocking into this. So first thing you need is a trading method. A lot of you out there have your own individual methods and methodologies, systems, strategies that you use in which to get in and out of the market. That's what a trading method is. It's a setup. You got to know your time frame, your setup, your entry and exit. That's essentially what it boils down to. Time frames, today we're going to cover more of a short-term method and how I use PitView to confirm that. The setup, I think you'll find extremely easy because all we're trying to do is really follow the market makers and piggyback on momentum as it breaks out in the market, and then go through the entry and exits and how we can increase the probability on our method with our entry and exits by using what we call pair view. Very simple. So the trading method I'm gonna go over today is one that I've been using, and it's probably been one of the most consistent trading methods that I've used for short-term trading over the last 12 years. It's called London Breakout, and just like any trading methodology, it's not always firing in all cylinders. There's times when it does very, 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 very well. There's times when it does not so well, but out of all the strategies that I've seen in the market, especially for short-term trading, I find this to be, for one, it's easy to understand, and two, it makes sense. A lot of the strategies that I utilize in my own trading, they have to have some common sense attached to them as far as why we trade them. So London Breakout, what it is, the time frame that I use for trading this method is a 5-minute chart. And as I said, be patient with me because PitView is not even going to come up for about 3 or 4 more slides here when we get into our entry and exit confirmations, but I want you to understand the method first. So time frame is a 5-minute chart, and the setup, we always know what, as far as pairs, which pairs we're going to trade. When you see London Breakout at the top of this header, what it means is we're going to be trading the London session. The London session tends to be the most active from open to close trading session. And one of the reasons for that is because in the Forex markets, probably by far the largest amount of volume that comes from liquidity providers and institutions comes through the European banks and London banks. They tend to be big players in this market. So with that being said, we tend to trade the regional currencies during that session that have the highest probability of what we call exerting momentum during the London session. If you're a trader in London or in Europe, chances are you're probably either trading the euro, the Swiss, or the pound, which are also 3 of the most actively traded currencies overall in any trading session. So this is one where we kind of pick one, and I'll go through a little bit of how we can use the global view to choose which currency we're going to trade on an individual basis that will give us the highest probability. But generally speaking, I stick with either euro dollar, dollar Swiss, or pound dollar. Reason for that is those are what we call the major pairs, and those are the ones that generally have the most amount of liquidity available through being a major pair during the time frame in which we trade. So again, unlike last Wednesday where we went through how to pick a pair, we can do that here, and I'll get into that a little bit later. However, this is one where I'll generally just trade one pair at a time, and I generally will only get one trade opportunity per day on this. So this is not one to where I'm trading in and out of the market several times a day. Generally, I'll either get one signal or I don't get a signal. So my maximum opportunity per pair that I trade would be one trade per day. Now you may be thinking to yourself, well, Steve, this is supposed to be a short-term trading method. And it's not necessarily it's a short-term trading method in that I'm in and out in the same day. But a lot of people will confuse short-term trading methods with what we call scalping, where you're going in and trading 15, 20 times a day. This is just one where we look for probability to present itself. We enter into one trade. If that trade hits, we're happy. If it gets stopped out, sometimes you get the elevator, sometimes you get the shaft. In this setup, and this will also lead us into several things that we'll be talking about in the coming weeks as far as other indicators we can use along with PitView. One of the indicators that I really like is what we call the ATR, the average true range. The setup that we use for this, that I personally use for this, is the 30-day ATR, the average true range. And I look for what I call Asian consolidation. Now, as a presenter and instructor, I don't like to have a million different words on my PowerPoint, so because I want people kind of listening to what I'm talking through. When I talk about Asian consolidation, there's three characteristics of how price moves in a given day or in a given time frame. It doesn't even have to be intraday. It can be over a longer term, medium term, or short term time frame. When I say Asian consolidation, the three characteristics of price behavior in the market, is consolidation, momentum, and reversal. Those are generally, in any given day or time frame, those are the three directions that a currency can move. Generally, a currency will tend to consolidate, meaning it will trade in a very tight range. It'll exert momentum, meaning the buyers or sellers will come in and either push price action in one direction or the other. And after they exert that momentum, at some point there tends to be some kind of slight reversal as people start to take profits during the day on their momentum strategies. And so it tends to go this way and then either up or down, and then at some point reverse to an extent during the day. I tend to keep things simple: consolidation, momentum, and reversal of those three directions. In this case, we are looking for these one of these three pairs, euro, Swiss, or pound, to be in a what we call consolidation mode when it comes to its average range on an intraday basis. And don't worry, I'll go into specifics on that. I won't keep it that vague. PitView, we're going to use the 1 hour totals and the 5 minute totals on PitView. Specifically on PairView, I should say on this. I'll pull up PairView when we get into the more. This is what we call a PitView filter, or a trade filter, that we use on determining whether we should buy or sell a currency. So the PitView, I'm using a 1 hour total and a 5 minute total for what I call confirmation on this trade, or you could even call it what I call a trade filter. The entry is what we're looking for is what's called a consolidation breakout. One thing that we'll certainly get into, and this should give you a little bit of an example of that as we go through, is that as currencies go through different sessions that are traded, there's four main sessions in the market. There's the Sydney session, the Japanese session. I usually call both those sessions what I call the Austrasian session. Sydney and Japan I kind of chunk together because it tends to be the least active session. Then we have the London session that starts at about 3 a.m. And then we have what's the U.S. session that starts at 8 a.m. Eastern time. And forgive me, I'm on Eastern time, so my times will be on Eastern time when I go through this. A U.S. Eastern time, I should say. And so the entry is what we're looking for is a consolidation breakout. So I'm going to take you step by step through the method first of what the rules are, because that's what we trade with. We trade with rules. Exit, we use 1-to-1 risk reward, or we can also use PitView, or more specifically PairView, to come to a look for our potential exits in the market. But first, let me start off with just the basics of this method. Let me go through a step by step of how we execute on this method. Depending on which pair you choose, and again, you can do this on euro dollar, dollar Swiss, or pound dollar. We can also use global view to pick one of those, and I'll try to cover that here at the end of the class. On a daily chart, I know we're trading off a 5-minute chart, but generally, if most of you use MetaTrader, I'll show you how to pull up the ATR on MetaTrader. On a daily chart on the pair that we're trading, we want to find the previous day's closing 30-period ATR, or average true range. Why is the average true range important? The reason why the range is important on currency pairs is because most people live under the misconception that currencies trade an unlimited amount per day. You even see a lot of scoundrels that are educators or instructors in the market that come up with these trading systems to where they say, trading the euro dollar with one micro lot, I made, between 200 and 300 pips a day. It's kind of hard to do that when the euro dollar right now is only trading about, it's only trading about 50 pips a day, I believe. There's a great question here that came from, hold on a second, let me pull up my questions. Including Sunday candles or not? That's a great question, because generally speaking, on the MetaTrader platform, you don't want to include Sunday candles in the 30-day ATR. There should only be 5 daily candles. The reason why there's a big hoopla about Sunday candles is that there's a lot of platforms where the data can be a little messed up because they consider one day in the market being like 3 hours of trading on a Sunday at the opening of the market. Most brokers, I should say, the majority of brokers, I should say, they should put their data feed to where the market opens at 5 p.m. or 100 hours on MetaTrader is in tune with 5 p.m. Eastern time, because that would leave it to 5 daily bars. If you're able to adjust your server setting to where 5 p.m. Eastern time represents 100 hours, you shouldn't have a Sunday bar. You should only have five bars or candles on your chart. That gets that's something we can talk about a little bit later when it comes to individual indicators, but no, we don't like to include that Sunday bar because it can bring down their averages. But back to the range, how can we adjust that time? On MetaTrader, you can either adjust the time through adding in a plugin or going with a different data server by calling your broker. If you call your broker, all you have to do is ask them, how can I get my chart settings adjusted to where my daily charts start 100 hours on the MetaTrader represents 5 p.m. Eastern time, or the opening of the market. Just tell them that you don't want the Sunday bar on your chart. So that's something that might take some legwork for you because each broker and each platform is different. This is one thing where when you're trading in the Forex markets, because there are so many different data servers and there's so many different types of platforms that are available in trading, I can't speak for all of them. What I'll generally tell my students, brokers are there for customer service. So you need to, all you need to do is call your broker and say, how can I avoid the Sunday bar? How can I get my charts adjusted to where the daily charts start at 100 hours on the MetaTrader platform? And they should be able to walk you through that. So it does take some legwork because I can't speak for every broker, every data server, or every trading platform, unfortunately. So what does this look like when we're on a daily chart? Well, in this case, we're going to use the Eurodollar as an example. This one, the chart I pulled this up on to capture it, I think is on one of my demo accounts that includes a Sunday bar. I had to get my ATR off a non-Sunday bar platform, speaking of the Sunday bar. But the ATR is right down here, and what it's doing is it's capturing and measuring for the previous 30 days on the chart. It's measuring out what the average range has been from high to low. So it's kind of like a moving average for the range. And again, the reason why this is important is because currencies do not trade an unlimited amount of pips each day. They tend to exert themselves in a certain ranges during the day, and a lot of institutional traders will look at the range or the average range on pairs, especially on a purely technical day, to decide, how much does this individual currency move? Because once it exerts that range, that's when things tend to reverse each day. So the 30-day ATR, as of right now, or the previous day's close on this PowerPoint, stood at right at about 50 pips on the Euro-dollar pair, meaning in any given 24-hour period from 5 p.m. Eastern to 5 p.m. Eastern, the Euro-dollar moves approximately 50 pips on average. It kind of speaks for the market when you think about it nowadays. A year ago, the Euro-dollar moved an average of 100 pips, but because of a lot of the indecision surrounding a lot of the pairs as of late and a lot of the individual currencies, volatility has really dried up in the markets. And unlike most people say, no, it's not going to last forever. Now, hold on a second. My mom was an English teacher, so she would certainly not like it if I was misspelling things on the PowerPoint. Find the Asian or Sydney range. I call this the Austrasian range. So step one, we just want to get an idea of what the range is. How many pips can we expect the Euro-dollar to move in a 24-hour period? Step two is we want to find what the Asian range is. Now the assumption here in this trading method is that you're going to be trading the open of the London session. Now, do you know what the open of the London session is here for me? It's 3 a.m. Eastern time. I have no problems with that. Generally, I'll kind of set my alarm for 2:30. I'll go to bed and I'll wake up about 2:30. I'll check out the Asian or the Sydney range, and I'll trade this method, because what you're looking to do is trade the opening of the London session. So at 3 a.m. Eastern time is when that occurs for me. 8 a.m. London time, by the way. So the second step in this is all we want to do is find the Asian, the Sydney range. From 5 p.m. Eastern time to 2:59 p.m., and that should be 2:59 a.m., sorry. Wow, I'm on a roll. So from 5 p.m. Eastern time to 2:59 a.m. Eastern time for me, we want to find the Asian high and the Asian low. So during the Asian and Sydney session, in this case, we'll use an example using the euro dollar, but I want to remind you, you can do the same strategy on euro dollar, dollar Swiss, pound dollar, or some people choose to use these on several of the crosses that those currencies trade against. And you can use the same rules for any of the pairs, including those three currencies, but I usually stick with the dollar pairs. So the reason why we want to just look for the high and low is we just want to calculate what the Asian range has been. Essentially what we want to know is during the Asian session, I call it the Austrasian session, we want to ensure that the pair that we're trading has been consolidated during that time frame, meaning it hasn't exerted the majority of its momentum. It hasn't exerted the majority of its range for the day yet. So we would calculate the Asian range from there. All we want to do is find the high and the low. Like I said, it's actually very simple to look for on a chart. On our 5-minute chart, the daily chart we just want to use to get to find the range, the 30-day ATR. Once we have that number, we can go straight to our 5-minute chart and start looking for a trade. So in this case, we have the Asian high at 1.35479, the Asian low at 1.35233. So the Asian range is sitting right at here at 24.6 pips from the low to the high. Now that's pretty simple to do, correct? Find the Asian high and the low. So when we're determining, that moves us on to step 3. And don't worry, I'll pull that chart back up here in just a second. But we've established where the high is, where the low is from 5 p.m. to 2:59. You can actually trade this from a phone if you wanted to by calling your broker and saying, hey, what's been the range on the euro dollar from 5 p.m. to 2:59 a.m. Eastern time? How does that translate into London? During the London session, that would be from 5 p.m. to 3 a.m. That would be 7, 10. That would be 8. That would be 10 p.m. to 8 a.m. London time. I had to think about that for a second. 10 p.m. to 8 a.m. London time. I know we got people from overseas here. Now, we're about to get to where PitView helps us with this, but the first trade filter that we have in a strategy like this is we are looking to trade a momentum breakout during the London session. In order to trade momentum, we need to ensure that the pair that we're trading has been in consolidation mode during that Asian session, during that Asian and Sydney session. So consolidation means if the Asian range is less than 50% of the 30-day ATR, doesn't make sense either. I apologize for this. This is just all messed up. I had made some changes to the PowerPoint this morning to add live examples, and I kept on copying and pasting right before class started. If Mom was watching it, she'd be like, Steve, this is why we have editors in the market. If the Asian range is less than 50% of the 30-day ATR, we would move on to step 4. What we mean by that is we want the range, whatever that 30-day range is on the pair that we're trading, we take 50% of that, and we want the Asian range to be less than 50% of that average range. The reason for this is because we're going to be looking for a momentum breakout, and we want to make sure that there's what we call room to go. Now, have any of you ever heard what room to go numbers mean? Room to go means that if you're trading in an intraday method, you want to ensure that your trade has room to move before it exerts its entire range for the day, before it hits any type of support or resistance level, or an influx of supply of alternating supply or demand. So this is what we want. We want consolidation. This is what's called a trade filter. If the market is not consolidated on the pair that we're trading, then that would be considered momentum. If the Asian range is at or more than 50% of the 30-day ATR, we would not have a trade. If it is less than 50% of the ATR, we can move on to our trade. Somebody just had a question on trade filter. As far as trade filter, what many people don't realize in the markets is that the best trading methods for trading in the market, a lot of them don't have what we would call sexy entry and exits, meaning some of the best trading methods I know of, a guy might just use price crossing above a moving average as a buy and price crossing below a moving average as a sell. If you blindly took that moving average and took those buy and sell signals, you might have a losing trading method. It might suck. Where most trading methods are born is through what we call trade filters or trade setups. What are the ideal market conditions in which to place that trade, into which to take an entry or an exit? In the case of a London breakout method, the ideal market conditions is that the pair has to be consolidated during the Asian session. Because what we need is once price breaks into either a new high or a new low during London, we need the price to have room to move based on its average range from its low to high. We need it to have room to go to either the up or the downside. That gives us plenty of probability in which to hit our max loss or max profits. So in this case, on the euro-dollar example we were using, the 30-day ATR would show up as approximately 25 pips. Okay, if we took 50% of that 30-day ATR, it would come out to 25 pips. 24.6 pips is less than 50% of 25 pips, so that means we can move on to step 4. All we need is we need to make sure the range is less than 50% of the ATR. I know it's a long, drawn-out process, but this is just the setup for our trade entry. The filter, if you will, because we haven't even gotten to the entries or exits yet. Step 4 would be entry and exit. First, we have an entry time. The entry time technically on this is you want something to break out into either a new high or low during the London session. Between 3 a.m. and 12 p.m. Eastern time would be your entry time. The earlier the better, because once we get to 12 p.m. Eastern time, that's when the market starts to slow down. But technically, you're at 3 a.m., that's when you wait for your entry to happen. If an entry is going to occur on this method with true momentum, generally it's going to happen within the first, a lot of times it's going to happen within the first hour after the London session opens, because that first hour of trading during the London session tends to be highly volatile. So between 3 a.m. and 12 p.m. Eastern time, so the London open to close. Here's where PitView goes into play. There's another filter that we would take on this, and this is just for our buys and sells. I'll get to what the actual buy entry and sell entry is here in just a second. But at this point, this is how I first started implementing PitView into my trading method. This is one of the first things I used it for that I've had a lot of success with. So that's why I'm showing this to you, to kind of bring everything together of a simple way to implement PitView into your trading method. My buy entry filter, and I also call it a whipsaw filter. On pair view, on the 1 hour total and the 5 minute totals, in order to take a buy entry, I need both the 1 hour total and the 5 minute total to just be green. That's all I need. I need it to be green. I need it to confirm buy imbalance to the upside with the market makers, to confirm that I'm actually on the right side of the market, that I'm trading along with the big money. That's the entire reason this thing exists, is to get us on the same side as the market makers. The sell entry filter, which I also call a whipsaw filter, the pair view 1 hour and 5 minute total has to be red. meaning a sell imbalance to go along with my sell entry. Now, this brings up if you're a geek like me when it comes to trading, you're probably wondering, well, what do you mean by a whipsaw filter? And this is something that's very interesting in the markets. You'll see when we get into our actual entry and exit, what we're waiting for is when price breaks above the Asian range, that would be a buy, and when price breaks below the Asian low, that would be a sell. What a whipsaw is, and we all know what a whipsaw is, it's when something comes up and triggers an entry for us and then comes down and stops us out, right? Or it comes down and triggers a sell entry and then it proceeds to go all the way back up and stop us out. That's what being whipsawed in and out of the market is. And there's nothing that can 100% truly protect against that. There's only things that can increase our probability against it happening, but nothing that would be 100% because it's going to happen. An unexpected news announcement might come out, a news announcement, major news announcement coming out of Europe that's scheduled, or out of Great Britain that's scheduled. Those can all kind of whipsaw or come out as surprises. So there's nothing that can fully prevent those from happening. However, on a purely technical level, PitView is something that I've found has an enormous impact on keeping me out of some of those whipsaw trades, and I'll show you what I mean here in just a second. So before we go into the buy entries, let me just rehash that real quick. On PairView, we would look at the 1 hour and 5 minute totals. It's the first way I started using the PitView indicator. The 1 hour and 5 hours would have to be green. I'm not looking for a certain number as far as the imbalances. If they're just barely green, I'm fine with that. The 1 hour and 5 minute totals would have to be red. I just want to know that I'm on the same side as the buy and sell imbalances. Now, as far as my exact entry, my buy entry would be after 3 a.m. Eastern Time. If the 1 hour total and 5 minute total is green, I would buy when the price breaks the Asian high by 1 pip. Okay? So at 3 a.m., that's my entry time. After 3 a.m. Eastern Time, if the 1 hour total, it'll show up as 1 hour T and 5 minute T, or 1 HT and 5 MINT. If they are both green, I would buy if the price breaks above the Asian high by 1 pip. My sell entry is just the opposite. After 3 a.m., if the 1 hour T and 5 minute T is red, sell when the price breaks the Asian low by 1 pip. Very simple entry and exit, because all you're waiting for is for the price to break through a high or break through a low. If it's confirmed by PitView either being green or red, which is simple enough, then that just means that just from a probability standpoint, we're at least on the same side as where the buying and selling pressure is from the market makers. So let me show you what this would look like on the screen when we're looking at a trade entry. Okay, here's the FX pair view on the euro dollar right in here. This would be an example. Okay, so I have my pair view up on my screen, and right over here we see that the price breaks the Asian low. Like here's the Asian low right over here. You see the blue line, and then we see the price breaks the Asian low by 1 pip. It gives us a sell entry. Now, in the old days, before I saw PitView, what I would do is I would blindly take that sell entry. I would just take that sell entry, and that would be what I would use it for. Just price broke the Asian low. It's consolidated during the Asian session, so I'm going to go ahead and take a sell entry on this. However, that would often lead to that whipsaw effect that could occur on some of my losing trades. So with PairView, what I'm doing is I'm waiting for the market makers to confirm my entries also. If you look at PairView, I'm not looking for a huge imbalance on the buy or sell. I'm just looking at the totals on here. And again, just a very simple way. It's not a complex thing to look at, in my opinion. You see it's just barely red, but at the same time that price breaks the Asian low by 1 pip, PairView shows red in the 1 hour time frame and red in the 5 minute totals. So we have two things occurring here. We have price breaking through the Asian low. It's broke through the Asian low by 1 pip. PitView has confirmed this as far as the imbalance goes because it's red on either side. Some of you might look at the numbers and the totals here. However, in my opinion, the numbers and the totals, there are certain times when you would want to use them to look for specific type of imbalance numbers, and other times when you might just look for it to be green or red, as in my case, to confirm an entry. So what would be the action from here? If we're getting a sell entry on Eurodollar, all of our trade conditions have been met as far as it has been consolidated during the Asian session. It's breaking out into a new low. We have plenty of room to go. So what would be the action here? And it's also being confirmed by PitView. Good. That would give us a confirmed sell entry. Now, if it broke through the Asian low by 1 pip, and let's say this was green up in here. Let's say the 1 hour was green and the 5 minute was red. I might exercise some more patience there on my 5 minute chart if that were the case, because that's always going to be the next question from especially my students. They're going to say, well, what if the 1 hour total is green and it's giving you a sell entry? Well, I might wait and see if that 1 hour total would go red. Vice versa. If the 1 hour total is red and the 5 minute total is green, I might wait for that 5 minute total to go to red before I took an entry. And once it ticked to red, I might wait for that 5 minute candle to close. And if it closes and PitView is red, then I would take my entry. So more often than not, the two will happen simultaneously with one another. But what we're using the pair view for in this case, just the bare basic pair view, is just as a trade confirmation, which is one of the easiest ways to start off using PitView. Because that's the entire point, isn't it? You want to be along with the imbalances. When we show those red imbalances, it means that the action by the major liquidity providers in the market are favoring the sell side of the equation. They favor selling or lowering their ask price more than they favor buying or raising their bid price. And it just happens to be coinciding also with the opening of the London session, where we know that there's going to be liquidity that's being provided to the market. With all those things being taken into account, it can be a powerful confirmation tool in the market. How powerful, might you say? I'll show you here in just a second. So the action here would be our sell entry. We're looking to get in once it breaks the Asian low by 1 pip. It's broke the Asian low by 1 pip. PitView, pair view is showing red on the 1 hour. It's showing red on the 5 minute. So my sell entry would be right here at 1.35223. It's making a consolidation breakout, and PitView is confirming that. So as far as the rest of the entry and exits on this very basic and simple system, is the stop is placed at what we call the opposing signal. The opposing signal just means that your buy entry is 1 pip above the Asian high, your sell entry is 1 pip below the Asian low. So if your sell entry triggers, your stop order is put above the Asian high by 1 pip. So that's what we mean by the opposing signal. And you're taking the first trade that occurs. Whatever the first trade, the only trade that you get, like I said, you're only going to get 1 entry off of this, whichever one happens first. If it breaks the Asian low first, your signal on this strategy is just a sell entry. If it breaks the Asian high first, your strategy is a buy entry. You're not taking either trade. You can put in, but one cancels other essentially. If your buy entry is the first that happens during the day, you would cancel a sell entry. If your sell entry is the first to occur throughout the day, you would cancel your buy entry. So the stop is the opposing signal, and the limit that we generally look for as a minimum. In my trading, we're always looking for a minimum of 1-to-1 risk reward, meaning based on where your entry and your stop is, you're looking for a minimum of a 1-to-1 risk reward ratio. Or once your limit is reached, one thing, and I'll be talking more about this as we have more classes on the PitView indicator, is once your limit does get reached, oftentimes PairView can keep you in trades a little bit longer to gain more profitability if you're on the right side of the markets. So once your limit is reached, what you can do is you can use that 5-minute total. If you're trading over the short term, if you just want to piece out your trade and try to keep your profits running a little longer, you can stay in it until the 5-minute totals reverse to try to add more profitability to your trade. When I say shows opposing sentiment, what that means, that's what I believe PitView is so great at. I think PitView is awesome at being able to measure market maker sentiment of whether they're more on the buy or sell side of the equation in any given day. We'll go live here to the charts here in just a little bit, and I'll show you what that would look like. So here we go. Here's the euro dollar. There was our sell entry right down in here at 1.35223. Our stop would be put 1 pip above the Asian high. Whenever you're calculating buy entries on the MetaTrader platform, and especially if you're calculating buy entries for something that's breaking into a new high, a lot of times what you'll have to do also is account for spread on the buy side. Most MetaTrader forward charts are driven off the bid price. So when something is breaking into a new high, your stop or your buy entry is going to be 1 pip above that high. It has to break that high by 1 pip. Well, since that high is being shown on the bid price, the ask price is always going to be higher than the bid price by the spread on whatever platform you're on. So I'll add like not only 1 pip for my entry, but also another 2 pips for spread on the buy side of the equation, whether it be my buy entry or my stop order. So in this case, the way my limit would be measured out is I'm risking 28.6 to make 28.6 pips. That would be my limit. And everything is confirmed here. You can see PitView is confirming the entry. The limit is a 1-to-1 risk reward. We got our sell entry, we got our stop. I'll show you what that looks like because I always update my charts to show current results, if you will. How does PitView help this system is what most people are going to ask as far as this system or this method when it comes to the entry and exits. If I go through the last 20 trades, before I even knew PitView existed, I used to trade this with the same rules, only without the buy and sell entry being confirmed by PitView. The last 20 trades without what I call the PitView filter, it's also what I call the whipsaw filter, would be 12 winners with an average of 21.6 pip average win, and 8 losers with an 18.6 pip average loss. Now that's without using PitView to confirm my buys and my sells, okay? Because without that PitView, a lot of times what will happen is, and here, let me just go back on the charts. What will happen is the price will come down here. The price will come down here and hit your sell entry. And this is one of the problems. Price will come down, 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 hit your sell entry. Your sell entry will trigger. And then the price will come right back up right after the London session opens and come out and trigger your stop and trigger your stop order, and you would lose out. And that's I'll put a W on that because that's what we would consider to be the whipsaw effect. What PitView is doing over here is it's trying to keep you out of those potential whipsaw trades, because more often than not, when that happens, when this sell entry occurs, and if it were to come up and whipsaw you out of the trade and stop you out, more often than not, the reason why I've used these indicators on the 1 hour and the 5 minute is the fact that these will still be green. Either the 1 hour total will be green and the 5 minute total will be green, and it will still be breaking out into a new low, which can occur, by the way. PitView is the ultimate confirmation tool when it comes to that, because what's shown on PitView is not shown on the chart. It's showing the imbalances between the bid and ask prices. I don't know if any of you find the power in that or what the fascinating aspect of that, but I think if you're a true trader, I think that's about as powerful as it gets when it comes to an indicator confirming a trade, because that's what it's doing, is it's trying to keep you on the right side of the market makers. Now, taking those same 20 trades into account, the last 20 trades without the PitView filter had 12 winners and 8 losers. If I use the PitView trade filter, this is what the same results would be. Now, you'll see here that I had 1 less winner than the 12 that I had, which is fine because it didn't confirm up. The PitView indicator didn't confirm my entry. But you can also, what should stand out to you here is this right here. Now, it didn't keep me you'll notice it didn't keep me from having any losses, did it? You're going to incur losses no matter what tool you use, unless any of you have a crystal ball that can foresee the future. And if you do, just call me and we're going to hook up. But how many of you are okay from taking your losers from this down to this, as far as your losing trades? That's why we use confirmation tools, right? To try to keep us into the most ideal market circumstances. So it would have kept you out of the five of the losing trades while maintaining the majority of your winners. One of your winning trades would not have been confirmed by the pair view indicator, but 5 of your losers. That's where you see where the probabilities lie in PitView. Is 5 of the freaking losing trades would not have been whipsawed in and out if you would have just confirmed it using that pair view during those 20 trades. The exact same way I did it on the chart. It's amazing how powerful a tool can be when it only takes 1 second to confirm it. Comes down, breaks the low, bam. I just got a sell entry on my London breakout strategy. Pull up pair view on the 1 and 5 minute. It's red. Takes a second to do. And bam, I'm going to go ahead and this gives me just added confirmation to take this sell trade or to take the buy trade on the buy side of the equation. I think when you go in and average those out, I think that's one of the most powerful ways in which you can use, now not just this trading method, but any trading method, just using this as a confirmation tool. Other ways we can use PitView in this method would be you can use Euro, Pound, or Swiss. You can use Global View to try to filter out which one of those 3 currencies gives you the best opportunities as far as strength and weakness goes in the market, which currencies are in play. You can use that Global View, and for this case, you may only need it on like a 1-hour time frame. Since you're an intraday trader, you may just be looking at just stepping it up to a 1-hour time frame to look at where the Global View is of ranking the currencies from strongest to weakest. I'll show you what that looks like. Now, one thing that students always ask me when it comes to like active trade management of what constitutes actual entry and exit signals using PitView or pair view, if you will, are the imbalances themselves. In this case, I'm just looking for PitView to be green or red to confirm my trade. However, there's another active trade management portion, which as we go a little bit further on into our educational series, I'm going to be touching on a lot of these points. You can look for large imbalances to occur on the 5-minute totals, especially if you're trading off a 5-minute chart. People always ask, what are good imbalances to use? For example, if we go and look at a stochastic generally, the overbought and oversold territories would be like 80 or above or 20 and below on like a stochastic. On PitView, the numbers inside the imbalances, if you're using a heat map, they'll either get brighter red as the imbalance goes more to the sell side, or they'll get brighter green as it goes more to the buy side. And what a lot of students ask me is, what numbers would constitute a large buy or sell imbalance? Since the buy and sell imbalance is an imbalance between the percentage of time a liquidity provider is either raising the bid or lowering the ask, I would look at it to be more of a 60-40 type of rule, meaning that would be either a plus 20 imbalance or a minus 20 imbalance on PitView. If it goes to plus 20, that's considered to be a high imbalance between buyers and sellers. If you're looking for more active trade management to confirm, to just use it as an entry or exit tool in the market. That may not make as much sense to you folks that are brand new to PitView. But the entire purpose of this educational series is to make sure that we fill in those blanks. What I mainly wanted to do today is here. Let me go in here and pull this up. Can we get the setup slides on the website? Absolutely. I need to change them around to make the the spelling a little bit better on them. Here, let me pull up my MetaTrader chart, and let me just go over some of these things. Let me pull up my PitView. I'm going to pull that up. I'll pull up a couple of global view windows. I'll show you how I kind of look at it when I first start off. I'm going up here to indicators, and I'm pulling up multiple global view windows. I should be able to take it down from here. And here's my MetaTrader platform. To change your time frames, by the way, you can go down here and say, okay, I want my session length to be, that would be the session length on the left-hand side. I can make it 1 hour, 2 hours, 5 minutes. The minute length I can make 1 hour, 2 hour, 3 hour, 4 hour. The minute length I can make it 1 minute, 5 minutes. Since I'm treating this off a 5-minute chart, I'm looking at the section length in global view, and I'm going to keep it at 1 hour here. When I'm trading intraday, so what you see here is I have kind of my swing charts up. You know, top-down analysis using global view of looking at 4 hour, you know, what's been the strongest and weakest currencies from an imbalance standpoint for the last 4 hours, for the last 2 hours, for the last 1 hour. Now, when I'm trading intraday on the global view, this might be the first thing I look at, because remember, I can trade either the Swiss, I can trade the euro, I can trade the pound. In this case, I might look at it and say, okay, well, the euro and the pound, when it's negative, that means that those are both showing as weaker today. The Swiss right here at the top is a little stronger here today. So we have those three currencies in which we can trade, you know, at the top and the bottom of the list as of right now. At 3 a.m., you might, if you're trying to pick between the dollar Swiss, the euro, or the pound as it's breaking through, you might see which one is on the most extreme part of the range. If you get a buy signal and you have the Swiss right up here near the top, then maybe you'd want to choose dollar Swiss for that day. If you're getting a sell signal and you have the euro and the pound here near the bottom, you might choose either euro dollar or pound dollar. Generally, there's going to be some correlations between those three currencies against the dollar as far as where they move in normal market conditions. But that's one of the ways in which you can pick the pair on the 1 hour time frame. I chose euro because this morning on the euro dollar, when it was breaking out into those lows, like right in here, you can see this breakout into the low price here. That's where the breakout occurred beneath the low. When it broke out into the low, the euro was showing up as being the weakest at 3 a.m. this morning. It's still showing up as being near the weakest side of the equation. Now from here, you can narrow it down. Like here, I can click on my euro, go to my euro dollar here. Let me bring this up. Okay, there we go. And now I have my pair view right down here at the in the lower left-hand corner. Now, when you look at the 1 hour totals and the 5 minute totals on pair view, and you're on the euro dollar, here's where we would have gotten our sell on the euro dollar. Global view right over in here is confirming that the euro is still weak, even when we got our sell signal. It's still weak. It came down, it got very close to where our take profit would have been. Our stop would have been right up here above the low, or above the high, I should say. Here's the opening. These are still on the Sunday bar charts here. Here's the opening of the London session. Here's where it comes down and breaks the low. This is the same one I pulled. This is one of the off the PowerPoints from this morning, because I always like to use updated examples. So right now, when you're figuring this trade in, here's where a lot of people will go wrong when it comes to just trading overall. I got my sell order in, okay, my trade executed. This is the same example from the PowerPoint. My trade executed when it broke through the low. I already showed you where the pair view showed the 1 hour and 5 minute totals. It came down and entered. It came up. I was at a loser there for a while. It was a winner. It was a loser. And then it came down, and I had almost about 15 pips of profit in it. Came back up a bit. And now it's hovering out. Now, when you look and you're using PitView for trade confirmation, if you will, and don't worry, I'm just doing some live demo here. A lot of times this can be the confusing part to people. Based on what we're seeing right in here, and remember, when I'm doing short-term trading, I'm on the 1 hour chart here. Euro is still showing at the bottom part of global view for the last hour. So what that means is over the last hour, Euro has still been one of the weaker currencies. Okay? And remember, I'm trading short-term. The last 5 minutes, what do the imbalances show? The 1 hour totals and the 5 minute totals. It's still showing negative, correct? Now it hasn't hit my profit zone yet. It hasn't hit any type of one-to-one risk reward at this point. But here are some things I might think about as I go through and as the trading day is going through, especially as it starts reaching like 12 p.m. Eastern time, when it starts reaching noon or so, because my drop dead point on a trade such as this one is 5 p.m. Eastern time, the close of the day. It's an intraday trade, so at the close of the market, I'm gonna close this out at whatever profit or loss is in the trade. As of right now, should I have anything to worry about when it comes to this trade? If the 5 minute and 1 hour are both still showing red, and they haven't made any significant imbalances as of yet, in order to maybe convince me to go to more of to maybe close out my trade if I'm already profitable, I might wait for this imbalance to go to a plus 20 down here under the 5 minute totals. That might be something that could possibly take me out of this trade earlier to capture whatever profits that I have, to show that momentum might be swinging up on the euro-dollar pair. But as of right now, the euro is still showing at the bottom of the list on the 1 hour time frame, and it's still showing red under the 1 hour totals and the 5 minute totals. So would you have any problems? I know some people, they get impatient as the market day moves on, but would you have any problems keeping a short position on euro-dollar open in this case? That's my point. Does it give you a little bit more ease of mind, keeping this position open when you still have those imbalances that are working in your favor? It hasn't hit our max profit yet. It hasn't hit our max loss. The reason why I brought up using PitView as trade management also, when it comes to your, what might take me out of this trade before it hits my max profit, before it hits my max loss. Well, one thing that would certainly make me consider taking off my trade with a profit is if this imbalance under the 5 minute, since I am looking at a 5 minute chart and I'm actively managing my trade, if it were to go to a plus 20 or above, that would signal a huge buy imbalance on the euro-dollar pair. That's where the market makers are getting really outside of themselves, to where 60% would be favoring the buy and 40% would be favoring the sell. So that would be a plus 20% imbalance on the totals. Other than that, if it just keeps on, going from green to red, and I still show the euro at the bottom part of the equation on the 1 hour charts as a total, as a whole, as the currency itself, then I'll go ahead and I have confidence of keeping this short position open. That's where we're at right now. Now, let me show you how this works. If you have a couple more minutes, let me show you how this would work on another currency pair that we trade. Okay? The same type of strategy can be employed right here on the dollar Swiss pair. Okay? Here's the dollar Swiss. There's the Asian high. And there's the Asian low. Now, if you were trading the dollar Swiss pair right in here, Look where the Swiss is at on the 4-hour, 2-hour, and 1-hour. What's it showing? The Swiss is showing as one of the stronger currencies over the 4-hour, 2-hour, and 1-hour time frames when it comes to those imbalances that we were talking about, okay? When I narrow it down and look at Swiss from, here, I'll change it to my group view settings, and then I'll change it back over and I'll look at the euro dollar. Let's see, there's Swiss. There we go. In this case, when this broke through the Asian high, here's the Asian session right in through here. When this broke through the Asian high, remember, Swiss is showing as very, very strong over the 4-hour, 2-hour, and 1-hour time frame. Remember, this is dollar Swiss. When this breaks out into a high, it means that dollar is getting stronger and the Swiss is getting weaker. Okay, so you're trading Swiss weakness when this breaks into a high, because as this moves up, it's taking more and more Swiss francs to exchange for $1. So if you saw this information, if you saw the Swiss was amongst the highest and strongest currencies, and you can just look at it on the 1-hour time frame too, the Swiss is showing very strong from an imbalance standpoint. On the pair view, remember the pair view, this is showing dollar Swiss now. A lot of times they have to flip-flop the bid and ask the base and quote currency here. When this is showing red in through here, it's showing Swiss strength, and when it's showing green, it's showing Swiss weakness. When you look at it under the 1-hour time frame, it's showing red. So these all show green for the Swiss franc, and this shows red, which is the same as it showing green on those other time frames, because you see here under the group view how the Swiss is the base currency on all these. It's because they have to measure the imbalances between the bid and ask prices and make sure they're all on the same side. If you've traded Forex, you know that on some pairs the currency can be the base currency. On some pairs it can be the quote. PitView, in order to measure these things, has to put every currency as the base currencies in the group view and the global view. And then over here it will show it as it shows up on your MetaTrader. This is one to where Swiss showed a lot of strength from an imbalance standpoint once it triggered a buy signal. However, you would not have taken that, and of course it would have come down a little bit, and not as and it's been in relatively the same area, but this is one that would have taken you out and kept you out of a potential trade that's going either sideways or at a potential loss during the day. So this would not have confirmed a buy. The euro confirmed a sell, but the Swiss did not confirm buying the dollar Swiss in this point, because it was showing the Swiss as being too strong, and then over here. And it also showed the Swiss as being on the buy side of the equation, down in here, which in this case, if you would have triggered a sell signal on the dollar Swiss, it would have been confirmed by pair view, but not if you would have, not if it would have triggered a buy signal. It wouldn't have been confirmed by pair view. I may have gone a little bit above and beyond there at the end by going live, but looking at these currencies over here as far as where they've been over the longer term, especially if you're a short-term trader, looking at it, on the 1-hour time frame as I do on the 5-minute charts, it can act as just a phenomenal. It can act as a phenomenal trade confirmation indicator. It's actually pretty cool when you think about it. A lot of my friends who have grown up in the markets with me as professionals in the market, they really love this as a tool for confirmation. So if you're looking for one to trade, you can look for, as the price is breaking out, you can look for which currency individually is the strongest and the weakest in global view. You can use, if you're looking at more active trade management, which we'll be talking about a little bit further as we go a little bit more into the education series, we'll be talking about how to use it for an entry and exit tool. That's all I got for today, but let me just summarize what I wanted, my goal for the day. Based on a lot of student feedback of mine from students who are subscribers to PitView, and after last Wednesday's class, a lot of you already have trading methods. So I wanted to show you a very simple trading method that I utilize and that I used way before PitView even existed to buy or sell in the market. And I wanted to show you a very simple way, just a very simple way that I use it for confirmation and how it's increased the probability in my trading on my buys and sells, on getting me in to good trades and keeping me out of bad trades as far as a confirmation tool. We put the cart a little bit before the horse last Wednesday, so I wanted to start with something very simple and basic and something that you could all identify with, because I know all of you have your own individual trading methods in which you trade, and just a simple way in which it can complement that trading method. What's to come on tap? Well, as we go a little bit further into some of these intermediate presentations, advanced presentations, on Wednesday I'll be doing another very basic presentation on PitView, once again explaining what the buy and sell imbalances are and taking it to the next level of kind of explaining of how market makers work in the market. That'll be on Wednesday morning. But if you do have any questions, feel free to shoot me an email. But as we go a little bit further in, I will talk more about how we can use PitView as a standalone entry tool. As an entry. A lot of people will use tools for entry methods. I'll talk about other ways in which we can use our top-down approach to keep us in trades longer, to pick a pair, the three-step method, pick a currency, pick a pair, pick a trade. One thing else I want to do is I want to revisit technical indicators like the ATR. I want to show you how PitView can call out different reversals in the market and help you gauge when things run out of room to go and buy and sell movement, if you will. So all of those things are on tap coming up here in our education series, but I thought this would be a good starting point for us. And yes, I can make these slides available. All right, that's all I got, folks. I'm going to go ahead and turn off my camera. If you have any questions, you can email me. If you're not a subscriber yet, www.pitview.com/web, since we're on a webinar right now. Most of you I show are subscribers to PitView, but if you're not a subscriber as of yet, you can shoot me an email, and I will, or go to that web page, and you can download. You can either download a free trial of PitView, or if you're ready to subscribe, you can actually. That's a subscription website. Other than that, I'm going to go ahead and jump off here.